Air. Before we start, would someone like to pop on and just say a moment or two about what stage you're up to and what you're looking for and the key things you might like to get value from this meeting? Anyone want to hop on? Paul, can I volunteer you?
I don't mind doing it.
All right. Hello, Harry. All right.
Hello, how you doing?
Right. Hi.
Yeah, so we're at the point of almost having our minimum viable product finished and going into beta testing.
And which company and which product is it?
So this is VetScript Technologies with a product called VetScriber. It's a SaaS product for the veterinary industry.
We would have guessed that, all right, as it says on the tin. Okay.
We just got awarded an Innovate UK UKRI grant, smart grant, and we've spent the last sort of 18 months sort of trying to raise investors, but we've bootstrapped it to where it is, but we still need an investor at some point soon to do the launch.
All right, that is fantastic, and I think between us we should cover all the things that you'll be looking for on your near stage company roadmap, from the IP to the funding. All right, and maybe Kate, now over to you.
Yep. Sorry, I'll just interject. What we'll do, we'll start with Kate. There's people joining all the time. We are recording this. Here we go. We are recording this session, so it will be made available to everybody. So just to let you know that. I just want to say one thing before we start with Kate from Forresters, our patent and trademark attorneys, is when people are looking and startups are looking at raising capital, it's, I think, very important, and I'm sure Anthony will agree, to take a view of looking at it actually from the investor's point of view. Too often the founders are thinking, you know, I've got this great product or service, I'm going to push it out and everything else, and it's natural to do that, but at the same time, if you could wear the investor's hat and look at what they're looking for, then it's going to make your proposition and your presentations, sorry, I've got people coming in all over the place, much easier for an investor to understand. And with that view, one of the most important things with raising capital is protection of investors' money, whether it's through trademarks, whether it's through IPs and such like. And we have a number of investors, you know, on our books that we've known over the years, who will actually only invest in a company that's got some form of IP or trademark. And if you look particularly on like Dragon's Den and such like, one of the first questions they ask when somebody's got an idea that they present in front of them is like, what's your IP, what's your trademark, what's your protection, and such like. And, you know, so many times they'll just turn a company down on the basis that it could be copied very easily. There's no protection for the investors. So I think it's very important, as I say, as a founder, to understand what investors are looking for in the way of protection. And Anthony will explain a lot more later on the importance of SEIS, EIS, and what it is and what that means to investors in case something does go wrong, which unfortunately it does. But so with that introduction, I'd like to introduce you to Kate Selwyn from Forresters. We've got a chat running, so any questions you've got, please pop in there, come to mind whilst the presentation is going on, but we'll make available a session afterwards so you can actually ask questions to Kate and Anthony and Dan and myself. So I will stop sharing my screen, and Kate, if you would like to share your
I will go ahead. Do shout if you can't see anything.
Let me stop my video. Okay. Hang on, I haven't stopped yet. Sorry, hang on. Right, there we go.
Right, can you see my presentation?
Yes.
Yes. Okay, great. So yeah, thank you, Neil. As he touched on, so my name's Kate. I am an associate at Forresters. We are a full service IP firm. I am actually a patent attorney, UK and European patent attorney, and I work in the life sciences field. So yeah, I've been at Forresters for about 5 years now. So just click on to the next slide. So basically, what is IP? A lot of people probably haven't heard of it at an early stage of investment. IP is something that you create, so you design or you invent. And the main forms of IP are patents, trademarks, designs, copyright, and also trade secrets. So I'm going to touch briefly on patents, trademarks, and designs. Copyright relates to kind of literary or artistic or musical work. And trade secrets, that's another form of IP. That's a famous example of that is the Coca-Cola recipe. So that's kind of kept secret and no one knows about it. And then there's other forms of IP, which are kind of more in the biotech area, which is SBCs, plant breeder rights, and then there's also database protection rights. So what is a trademark? So a trademark is any sign that identifies you as the owner of goods or services. They can be registered primarily for a name, slogan, logos, but also colours. There's famous case law about the Cadbury purple colour. So the main requirements for getting a trademark is that it must be distinctive. So that means it identifies you as the provider of goods or services. It's unique to your brand. And an important requirement is that it can't be descriptive of the goods or services that you provide. So an example of that is if, for example, you were selling ice cream, you couldn't call it cold and creamy or anything like that. Trademarks, importantly, can last kind of forever. So that's a real advantage of getting a trademark. You have to pay annual fees every 10 years, but they can be renewed for an indefinite period of time. And you can get kind of UK and European trademarks as well as other countries, but we would say UK and European trademarks are the ones to focus on. So what is a design? A design protects the appearance or the physical shape, configuration, or decoration of a product. This can be either part of a product, so you see part of the trainer there, or the whole product. And again, this can be, we would say UK and European designs. And again, they have to be new, so novel, and have individual character. So they need to be unique and kind of not already out there. With designs, protection lasts up to 25 years and you have to pay fees every 5 years. For registered designs, this is an example of other stuff that you can kind of protect with a registered design. So you've got kind of the computer icons, the look of it, typefaces and graphic designs. So for patents, this is my area of expertise. This is an invention or how a product works. And this, importantly, is based on a first to file system. So the importance here is if you do invent a product, then you should look to file a patent application as soon as possible, because it's going to be the first person who files that patent who is going to be entitled to the patent. So if a competitor is also creating something similar, you don't want them to file the patent first. Patents last up to 20 years, but they have to be renewed every year. So there's fees involved with that. And the key requirements for patent protection is that it must be novel and inventive. So inventive is an inventive step, so it can't be kind of obvious to someone in the field to do your invention. It needs to kind of have an inventive leap. And also there are some requirements to exclusions from patentability. So this is kind of your business methods of playing a game, discoveries, scientific theories, mathematical methods. It kind of has to be an actual invention. There's also quite a few biotech restrictions, which I won't go into. So the most important thing about patent is that it should remain confidential. Your product should remain confidential until you file a patent application. So if you are disclosing your invention with investors, please make sure that's done under confidentiality agreements, or you make it very clear that it's confidential information that you're sharing. And then once you've filed your patent application, then you can disclose your invention freely. So the initial strategy that we normally use is to file a UK patent application first. This is because the UK has very cheap fees. So they will search the applications. That means they'll kind of have a look in the prior art as to what's out there already. And they'll issue a search report after 3 to 4 months. And this will say, yeah, your invention's new, or no, your invention's not new because this is already out there already. So we kind of get a feel for whether or not you're going to be able to obtain a patent after 3 to 4 months. So that's the benefit with filing in the UK first. Also, that initial UK application is a flag in the sand, so it gives you the date, and then you have 12 months to kind of decide where you want to go, if you want to file an international patent application, or just pick certain jurisdictions such as, you know, Europe or the US. So that's, yeah, that's the kind of strategy that we use for patents, but the really important thing is to keep it confidential until you file your patent. So just an example of a whole IP portfolio that you can kind of build up. So here's the iPhone, sadly very old iPhone model. But yeah, so Apple will have trademarks, they will have the technical features of the phone protected by patents, and they are constantly filing new patents for new developments of the phone. They are also likely to have internal trade secrets concerning kind of what's coming up. And the actual look of the phone will be protected by registered designs. And then also the internal software and any apps and stuff will be protected by copyright. So that's kind of everything that you could get as part of your patent portfolio. So yeah, there's a lot of different aspects of IP that you can cover within one company. So what do investors want to see? So the most important thing here is that your competitor may already have a patent or a trademark or a design, and you need to make sure that you are free to launch your product onto the market without accidentally infringing their rights. So this is called a freedom to operate. So do you have freedom to launch your product into the market? So the way we do that is we would look at your competitors' IP portfolios to see if they've got any applications pending and where this is and, you know, what it covers. And that's something that people often don't think about, is that actually your competitors might already have IP protection for a similar product that you're wanting to launch. And you need to be really careful that you are free to operate without at risk of being sued. So obviously investors want to make sure you're not going to be sued. And then also your own IP strategy. So have you protected what you're doing, and how have you done that? So have you, thought of your IP strategy? Have you filed these patent applications? Do you have the search reports back? Do you have an indication that actually your product is new and it is inventive and you can obtain patent protection or trademark protection? And also, how are you going to build on this? Are you going to continue to develop your product and file additional patent applications or designs? Do you have a pipeline of IP that's going to bring in more money? And also the patent box. So the UK government have various kind of strategies to encourage innovation in the UK. One of these is the patent box, which offers corporation tax savings. They've also recently launched a new grant for IP. So that provides SMEs with up to £5,000 to help protect and commercialise IP. That was just launched a few weeks ago. So we can offer further advice on stuff like that if you require it. Oh, sorry. And basically, yeah, about us. So as I said, we are a full service IP team. So we do designs, trademarks, patents, copyright, everything. What we offer is a free 30-minute consultation to discuss your IP. So yeah, either in person or by Teams or anything like that. And we also have a fixed price IP audit service for startups. So this, we can identify areas of IP in your business, what you can do to improve it, and provide you with a roadmap for achieving your IP milestones. This is often good to present to investors. Yeah, so as it says there, assist with writing IP sections of investment pitch documents. We can help with all of that. And then we also offer fixed price quotes for filing various, so as I said, the initial UK filing, the initial trademarks filings, we have set costs for that, that we can offer. Another thing we do is competitor landscape mapping. So that is, for example, if you have a known competitor and you want to see what IP they have out there, we can do a kind of landscape map to see what protection they have out there. And that helps with freedom to operate. And then just a brief introduction into our team. So these are some of our patent and trademark attorneys. And we have all areas of technology. So I'm the biotech, but we also have kind of the electronics, engineering, all of every kind of subject matter you could hope for, we cover it all. And then just here, a real life example of why actually IP is important. So You may or may not have seen this already. This is a DIY tool that is sold in Wix and Screwfix and all of that. So they came to us and we helped with their protection for their tool. So what it is, it's like a chalk pen that kind of shoots out a fluorescent green liquid, a bit like an inhaler, but it shoots out green paint. And the idea was that the problem that they were trying to fix there was when you were trying to put up something that had kind of a long distance between that and the wall, it was really hard to get the pencil or pen to touch the wall. So when you were screwing it onto the wall and doing the drill holes, it was really difficult to kind of figure out where you're supposed to drill. So the couple who invented this came to us with this invention to improve that, and it shoots out green paint onto the wall, so you don't have to fiddle around with a pencil. So what Forresters did, we did a background search to see what was out there already, to check that they should actually proceed with filing patent application. And the background search was positive, and so we filed a UK patent application, and then after 12 months they did the international patent filing. They also have a number of trademarks, and finally they also went on to Dragon's Den, and we helped with all the paperwork for Dragon's Den. And as Neal touched on earlier, they were kind of really interested in the IP behind this, and amazingly all 5 dragons offered to invest. They actually went with Deborah Meaden in the end. I think she gave a £50,000 investment, and yeah, sales rocketed. It's now stocked in all major DIY stores across the UK, and they're achieving amazing success. So that is why your IP is important. Yeah, so thank you very much for listening. My name is Kate Selwyn. I'm happy to answer any questions in the chat, either now or afterwards. My email is there. I will have to drop off at some point, but yeah, feel free to email me with any queries. I'll just look at the chat now. Let me stop sharing.
Okay, thanks very much. Yeah, there's a few questions in the chat.
Yeah.
Can you see it?
Yep. So yeah, I can see it.
Okay.
So there's one here, chicken and egg question. How do you balance the requirement for registered IP and the need for investor money to secure it? It can be expensive to register IP. Yep, and that's totally correct. IP is expensive, but that's because it's worth it for the protection that it provides. So the initial filing of IP is not expensive. So if you want to file an initial UK patent application, that's you know, a couple £100 to file the UK patent application. Obviously, the writing of the patent that might be a bit more expensive, kind of £3,000 to £4,000. But once you've got your flag in the sand, especially for a patent, then you've got your evidence to your investors that you are securing your IP. And even if you have an IP audit or anything like that, I think you're just showing that you're aware that you have freedom to operate, stuff like that. So yes, it is expensive, but it is worth it, and it is really important. Harry has asked, is it true you can't patent software? This is not actually my field of expertise. It totally depends on the requirements. So software can often be seen more as copyright protection. It depends what that software is doing. So I would, if you had a specific question on your software, please email me and I will forward that onto our tech team. Yeah, so Anthony, sorry, you just replied, I see, and I know you have a good story about Sky, so I'll let you touch on that when you get around to speaking. The trademark on the iPhone wireframe was very interesting. The design did not look very inventive. So for designs, it doesn't need to be inventive, it just needs to have individual characters. So does it look different to what anyone else is doing out there? So at the time it was filed, I think you forget how long Apple's been around. They would have filed that, you know, many years ago. So at the time it was filed, it would have had distinctive character there. Yeah, great. I think that's all the questions. But as I said, please feel free to drop me a message if you have any specific IP questions. It can be a very confusing topic, so we're more than happy to help. Back to you, Neal. Thank you.
Hey, thanks very much indeed. Can you just drop your email in the chat, because we'll send
Yes.
the chat out to everybody as well.
Yeah.
Again, founders and people looking to raise, I'd encourage, if you have some sort of product or service or, that you're looking at raising capital for, then Forresters, as I say, offer this 30-minute free consultation. I'm sure it can run over a little bit. It did when I introduced a contact I have in Indonesia, and it was very helpful. So I'll stop on that one because I know Kate's got to shoot off. Kate, thank you very much indeed. I hope it's sunny in Birmingham. And we'll move on. What we're going to do now is, well, I'm going to introduce you to Anthony Rose. If you don't know Anthony, again, as I always say, you should do. SeedLegals are the leading raisers for startups in the UK. Their platform is fantastic. So come back to what I said earlier regarding what investors look for when you're a founder trying to raise, wear the investor's hat, not the founder's hat. So you're going to need everything in place, how you value your company, what your legal documents are, what your subscription documents are, what your shareholding agreements are, and such like. And Anthony's going to explain how the SeedLegals platform does that, how they successfully raise, you know, more or less every day on LinkedIn now. I see a message from SeedLegals saying congratulations to XYZ company for raising 800 grand, 2 point something million, etc. on the SeedLegals platform. So I can't, and Anthony and I have known each other a number of years, we're great friends. He's a great supporter of us, and we're a great supporter of him. And so I would just like to introduce you to Anthony and say, Anthony, please take the floor.
All right. So hello, everyone. I'm not here particularly to plug SeedLegals, although I hope it's the answer to what you're looking to do. So I'm Anthony. I used to head up BBC iPlayer years ago. Then I left the BBC, built a startup, sold it, built a startup, sold it, got tired of paying lawyers to do the legals, built SeedLegals. We're now a little over 100 people, and about 1 in 6 or thereabouts of all early stage UK funding rounds is now done on SeedLegals. So over the next 30 minutes or so, maybe a bit less, I'm going to tell you the top 10 things, if it works out of 10, to get investment ready and get investment and build your business. So, and we're going to take a couple of use cases that we might hear in the room as an example that we've done when the recording started. So let me share my screen and let's crack on. So the very first thing is you incorporate your company. You have an idea, you know, it's just a hobby, you meet in the pub, you have an idea, and now you want to go and incorporate your company on Companies House. The good news is that it costs you £12 to do, and it's super easy. But here, people sometimes go crazy. They read about Mark Zuckerberg and his special super voting shares, and they try to do that themselves. My strong advice is don't do that. Just incorporate with the founders getting ordinary shares, because if you try to give yourself super voting shares, it sounds like a great idea, but actually the founders on day one own 100% of the shares. You don't need special shares. And if you try to create something super special, all that happens is you have massive investor resistance, and literally 100% of the time, we've seen companies incorporate with trying to make founders with 20 votes per share. It gets unwound at the point you find investors. So keep it simple. 100 ordinary shares increases your investability later. And one day when you get to IPO, at that point, you can make dual voting class shares, but kind of avoid it beforehand. So you've now incorporated your company and you've got some founders, and our data suggests that 2 founders is firstly the most common, and also companies with 2 founders tend to get funded faster and more effectively than companies with 1 or 3 founders. Now, it doesn't mean 1 or 3 or more is a disaster, not at all. There are many sole founder companies out there, but I think investors like to see that firstly, there's not a single point of failure, and secondly, if you think about your role as a founder, and here we digress completely from anything to do with the legals, but just as an aside, I think that a company needs essentially 3 roles. The domain expert, so the doctor, dialysis machine, mother, whatever it is, that's the passion. Number 2, it needs someone to build it. That's often the CTO kind of role or the product person. And number 3, it needs the Mr. or Ms. Money, somebody to help it get funded, be a vibrant business, be profitable, and so on later. And now if you look within yourself, which one or more of those are you? And if you cover all of them, fantastic. But in my case, I'm the tech product kind of guy. I know enough about the fundraising side now to take care of that. And it was actually my business partner whose idea it was, and more the domain expert. So 2, in the case of SeedLegals, is a good number of founders. And by the way, our data anecdotally suggests if you've got more than 3 founders, that's a crowd, and often a founder leaves a year or 2 in. So talking about founders leaving, the next thing is it's super important that the company has founder agreements with everybody. So a founder agreement, which you can do for free on SeedLegals, is a legal document between each of the founders and the company. And it's got 3 key provisions in it. Number 1, reverse vesting, which says if I leave the company, typically anytime in the next 3 years, I have to give back some fraction of my shares. And this protects the company against founder disputes, someone leaving. And our data suggests maybe about 10% of the time there's a founder dispute and one of the founders leaves. And sometimes they leave because they get a job somewhere else, they need to pay the rent. Sometimes you have a dispute. And sometimes they're what's called a bad leaver. And probably the most noteworthy bad leaver story is a SeedLegals customer got on web chat and said, our CTO is in jail charged with attempted murder after a drug deal gone wrong. What should we do? And my response, which I didn't tell them, was bad leaver. So the fact they had a founder or employee agreement with reverse vesting meant they could get their shares back again to then give to somebody else. And if you didn't have that, the company can easily be uninvestable. Very briefly, the other 2 things in a founder agreement are IP assignment. So all the intellectual property, the work you've done, the coding, the designs are now assigned to the company, which means if the person leaves, there's no dispute later. And thirdly, there's an undisclosure and often a non-solicitation. So the idea is that when you come together, after meeting in a pub and create a company, if someone leaves, the company is the vehicle that continues, and having these agreements in place is the difference between pistols at dawn and spending fortunes on lawyers to try and work it out, and going back to a contract and saying, we get your shares back again. And it happens all too often. And by the way, as an aside, from what I see, founders perceive from the stories they read in the paper that investors are out to screw them and they worry that the legals are going to try and have gnarly conditions that will force them out the business. Of course, on SeedLegals, we help you create the legals that don't do that. But actually, the biggest problem founders have, they're co-founders. And so to protect yourself that one of the co-founders leaves is important. All right, so next step, you now want to hire, let's say, your first employee, a CTO, which is often the first employee. And the problem is you don't have any money at this point. So what you're going to do? Well, they can work on a wing and a prayer, or you can give them equity. And you can give them shares, or you can give them share options with a often called an EMI option scheme, which means they get tax efficient way of giving them equity. So shares means you create a form on Companies House to allocate them shares, and share options means they get a right to shares in the future. And which of these should you do? Well, if the company's shares have got no value, then you can freely give somebody shares without tax implications. But as soon as the shares have a value, let's say you're close to a funding round, or you've done a funding round, and you give your CTO £100,000 worth of shares, they would have, as an employee of your business, a deemed tax liability potentially on £100,000 that's been given to them, and the company might have to pay national insurance and POA pension and so on, as if you'd paid the person £100,000. And so it could be a disaster. And so if the rule of thumb is, if the shares have no value, you can give shares to people. And if the shares have a value, create a share option scheme and give them share options instead. And so it's usually the early founders and early joiners who have shares, and employees later on get share options. And so now the question is, how do you give people options? And there's 3 parts to giving people options. So you employ somebody and you go, we're going to pay you, your market rate might be £50,000 a year, but actually we really don't have much money right now. So can we give you £30,000 a year because you're super early stage, and we'll now give you some share options to top that up. And if it's a success, great. And if it doesn't, well, it's all been a good, fun year working together. So hopefully you'll have a better pitch than that. But for that, to give people share options, you're going to do 3 things. Number 1, you're going to create an employment agreement with them, or a consulting agreement, which you can do for free on SeedLegals. And in that, it will say, I will give you so many share options. Number 2, when you do your next funding round, typically, although you could do it beforehand, but you save paperwork by doing it together, you're going to create a share option pool. And this is essentially a line entry in your cap table saying you have the right to allocate a certain number of options to people. And thing number 3, particularly if it's an employee, you'll create an EMI option scheme, which you can do on SeedLegals. And there you agree what's called an EMI valuation with HMRC that makes it very tax beneficial for both the employee and the company. And you can pop us a note or me a note. I'll put my email in the chat, anthony@seedlegals.com, to find out more about any of those. So, by the way, one of the key questions before I go on to the next slide is, how many options should you give people? Because if you have an advisor, so often people, when you get your pitch deck, it's nice to have an advisor page. I think people slightly over-index on the value of advisors, but it depends on how many years you've been around and whether you think that that will add value. But when you're talking to an advisor, the advisor might ask you for some share options, and then how many should you give them? And if the advisor says, I'd like 5% or 10% or 1% of the business in options, is that a crazy number or is it a sensible number? How do you decide? So here's my top tip, which is when you give people options, think about them as the equivalent pound value. So if your business is worth, let's say, £1 million, because that's your valuation in your next round, and your advisor asks for 5% in options, well, that's £50,000 value. So you might go, well, for £50,000 value, I can hire an iOS developer for a year, and you're going to breeze in once a month for a day. So that sounds excessive. I reckon more like £10,000 in options. And why didn't we vest that, spread it over 2 years? Because in the same way, I don't pay my iOS developer the entire annual salary on January 1. I want them to work for it. I'm going to give you your options vesting over 2 years. So if we wrap things up after 6 months, because you're not delivering, you only get a quarter of them. So 1% is £10,000, vesting over 2 years. Create an advisor agreement on SeedLegals for free, job done. So that's the way that I like to think of those. So now we move from, you've incorporated the company, the founders of shares, you've got some employees potentially, you've got agreements in place with everyone, and it's time to go fundraising. So the first thing you probably want to do is get your SEIS, advance assurance. So in the UK, the vast majority of early stage funding is from angel investors, people investing personally, getting SEIS, 50% tax write-off on their investment, or EIS, 30%, and they pay no tax if they sell their shares after 3 years. And if your business goes out of business, they can write off their investment. So SEIS and EIS fuel the UK early stage startup ecosystem. And there's something called advance assurance, which tells your investors, a letter from HMRC saying the company can offer you SEIS or EIS. Now, this letter is a comfort letter. It's not legally needed. But most investors these days, if you don't have your advance assurance, it's often the difference between, yep, I'm in, and call me when you've got your advance assurance. So it's usually worthwhile getting advance assurance. It's like an insurance to remove friction from your funding round. And HMRC is making it slightly harder each year to do it because they've had too many speculative applications. So you need to demonstrate what's called a risk to capital, and it's going to be a growth business. There's certain excluded activities, and you now also need to provide evidence of, we think, at least 25%, sometimes more, of the amount that you want to apply for advance assurance in committed, or at least intended, investment. So let's say you want to raise 300K. You want to apply for £300,000 of advance assurance, a letter from HMRC saying we will grant SEIS for £300,000 and EIS. HMRC would typically be looking for you to provide the name and address and intended investment amount of maybe a quarter of that, maybe a bit more. And if you don't have that, then HMRC will come back later when you've got it. And the idea is so that people don't waste their time. They saw a big increase in applications from people with no investors lined up. So you will need to get some intended investment. It doesn't mean committed. And because it's HMRC, don't make up stuff. But if you have investors, you might chat with them going, is it okay that we use you for our SEIS application? You're not committing to invest, but it will help us get the application. So you can do all of that, of course, on SeedLegals. So now you've got your SEIS advance assurance in play, and you now have your pitch deck, and you're going to talk to investors. And of course, you need to tell them the company valuation, because otherwise, if you're looking to raise £200,000, the percent equity the investor will get is going to be based on the valuation. So how do you value your business? Because you've noodled away on a few rainy Sundays, you've got a nice PowerPoint, you've coded something. Is it really worth £1 million, or is it worth £2? So how are you going to value it? So you've got a few things you can do. You can go to TechCrunch and look at, what companies have raised and the valuations there. But that's no good, because that's crazy US numbers, and you need to take at least 1 0 off the end of it. And of course, they're only the hyped up companies that are there anyway. Number two, you can go to the likes of UK Tech News or sifted.eu or other tech publications that often publish funding round info. But that's no good, because they never tell you what the valuation is. They just tell you how much the company's raised. Thing number three, you can go to your accountant and ask them to value the company. But if you do that, your accountant will go, are you profitable? And you go, no. And they go, are you making any revenue? And you go, no, dude, we haven't even built it yet. And they go, are you about to have revenue? And you go, no. And so they're going to say to you, well, remind me why the valuation is above 0. And by the way, it looks like you're not even a viable business anyway. So going to your accountant isn't helpful, because an accountant will tell you the current value of your business. But for the purpose of an investor, you're talking about the future value based on future potential. So the next thing you can do is you can create a spreadsheet that models your funding, your growth and revenues, and then use a formula to work out a valuation based on your projections. So you might say in year 1, I'll make 0 revenue, and year 2, £1 million, and year 3, £4 million, and year 5, £50 million. But the problem is, it's just a made-up number. There's nothing to suggest you'll actually ever reach those numbers. So any astute investor is going to treat it as BS. Well, I think a bit more than that, because it's interesting to see when the founder comes up with those numbers. It's a measure of your ambition and, in a sense, your numeracy. And if you say that your blockchain-based business is going to be doing £100 million in revenue on year 4, it's would be brilliant. You'd be a FTSE 100 company or 500 company, but it's statistically unlikely. And, if I see that, I'm probably not going to believe any of the other numbers, because it's never the case. You'd be growing faster than Twitter, which had less revenue after like 8 years. So unlikely to be the case. So what are you going to do? Well, there's another method, and that's what we've seen on SeedLegals. And over thousands of rounds, we've seen companies sell a median of 15% equity in a round. What does this mean? Well, it means that actually, when you're raising money, the investors get typically close to 15%. If your investors are asking for 30% of the business, send them to SeedLegals Resources Deal Data, where you'll see this chart, and explain to them, this is a bad idea. You'll be a minority shareholder in your own business and uninvestable in a couple of rounds if you do that. And in fact, it's almost never the case that that happens. If you try to sell 5% of your business, there's nothing wrong with that. But that means either your valuation is way too high, or maybe you ought to be raising more at the valuation you've got in mind. So 15% is, it's not set in stone, but that tends to be about the right amount, we think, to sell equity in a funding round. And that means that actually your valuation is simply 5 times the amount that you want to raise. So to give you an example, let's say you wanted to raise £200,000. Multiply it by 5, that means your pre-money valuation before the round is £1 million. And after the round, it will be £1.2 million, A plus B. And the investors will own 200K out of 1.2 million, which is 1 in 6, 16%, which is near as needed to that 15%. So essentially what you are in your mind doing is going, I need a certain amount of money, therefore my valuation will be that. Of course, that just moves the cards around because you still need to figure out how much money you need. But generally, so here comes the standard formula, which is every idea is different. But in the UK, from what I see, funding rounds follow a remarkably self-similar formula, which is step 1, founders, and here I will stop the screen sharing. Founders put a median of £26,000 of their own money into the business first, because no one invests on a PowerPoint. So you have to build something, otherwise it's a bit arbitrary. And that gives you enough that you can then go off and talk to investors. Step 2, you might raise 50 or 70K with friends and family, and you might use our Seed Fast product on SeedLegals or a bootstrap round to do that very inexpensively. And then you might do your classic £150,000, £200,000 SEIS round with angel investors. Maybe you've got 10 or 20 investors investing 10 or 20K each, sometimes more, sometimes less. And that's going to get you to product launch. And then you might do raise 500 or 700K seed round from angel investors and early stage funds. And then you may do, once you've got revenue, you may raise a couple of £1 million from a VC or several VCs together with angel investors and existing ones following on. And that would typically be once you've got a £50,000 a month or more in revenue. And you can see the pattern that each time you're raising 3 to 5 times the amount you raised previously at 3 to 5 times the valuation, such that after 3 rounds, if you've diluted by 15% each time and you've created a 10% option pool, then the founders will still have the majority shares, more than 50% after the 3rd round. So that is, to me, the formula. Now, of course, you can skip some of those steps. At SeedLegals, we've been around a bit longer, the founders, so we funded it more ourselves, and our first round was £1 million, and then we did a Series A round. So we skipped the early ones, but that's because we had exits before and we could fund it a bit further ourselves. But otherwise, mileage would vary. And but anyway, that's broadly the formula. So the last thing before I hand over to Dan is that once upon a time, my goal was to help you do a funding round. The problem with funding rounds, they're slow, painful, expensive. You have to raise enough to last you to the next round. But now there's a new way, and we call it agile fundraising. And the idea is you can raise before a round in dribs and drabs, and then you can do a round, maybe raising 2/3 of what you want to, and then you can top up the round afterwards. So instead of the, look, kiss frogs, just find, £300,000, you can actually be at some networking event like Exponential and meet some investors in the room, and they go, hey, we love what you're doing. Can we invest 20K? And instead of saying, come back in December when we're doing a round, you can go, yes, let me send you a seed fast, which will convert into shares when we do the round. So if you Google SeedLegals seed fast, you'll find a lot more info, and you can drop me a note on that. So now my goal almost is to help you not do a funding round by showing you how to raise before, during, and after round so that you can grow your business faster. So I hope that was helpful. It's Anthony@seedlegals.com. And now I will hand over to Dan. And while Dan's talking, I'll answer any questions in the chat. Hello, Dan. How are you doing?
I'm all right, Anthony.
Anthony, thanks very much. I'm trying to turn my video on. Here we go. I think there's a couple. Yeah, there's a couple of questions. Do you want to cover those quickly?
Yes. Okay.
And then whack your email in the thing. Well, we'll send that out anyway. But
all right. So, question from Alice: how long does SEIS process, and how much does it cost? So the idea. So yes, SEIS used to be very slow with HMRC. These days, it looks like they've staffed up, and it's actually really quick. So we see approval times of less than a week, sometimes even a few days. If it's a later stage company, it's very complicated, might take longer, but typically you can assume maybe about a week turnaround from HMRC. And on SeedLegals, we charge £300 to prep everything, prepare the cover letters and all the other things, and our team review it to make sure that it's accepted. And we take about 3 days to do that. So there's no need to procrastinate. You can do that fairly efficiently. And we see about a 97% approval rate. And the ones that are not approved are ones that are sort of not qualifying businesses. So leasing, electricity generation, gas exploration are not are disqualified. But most startups are well within that zone. So one more thing in your question, Alice, is to get SEIS, the company has to have been trading for less than 2 years. That means selling stuff or the doors open for business. You might have incorporated well before that and you've been working on it or doing nothing, but the clock starts ticking for 2 years for SEIS once you've had your first commercial trade. And if you have passed your 2 years, no problem. For EIS, the investors get a lesser good tax break, but they still get no capital gains tax on an exit and so on. That's 7 years. So again, drop me a note for more info on that. All right, now, question from Varun. How much do investors care on the equity split between founders? So is it a problem if the founders have got 50-50 share split? It's a great question. I think I don't think there's any particular problem. I think, however, that investors would be looking for everyone to pull their weight. So if you've got 2 founders with 50-50 share split, but one of them still having a day job and working on the company part-time, while the other one's given up their day job and it's full-time, you wouldn't be surprised if the investor would tell the first one, you need to give up your day job and be full-time in the company as a condition for my investing. And that's often the catch-22, which is you can't afford to give up your day job until you've got funding to pay yourself, and the investors aren't going to put money into the business until they see you fully committed to the business. And that's something that everyone's going to have to bridge that gap by ideally having a bit of a war chest you've built up yourself. So not only can you afford to pay your rent without any salary for some period, but can also put money yourself to get the company to be investment ready, given that I've said, you know, founders normally will put in a median of £26,000 from what we see. All right. So last question I'll do from
Might be
Dylan.
a good case though for vesting shares if you've got a founder who's coming on board post investment secured, I'm guessing.
Sorry, Dan, I just missed that.
Might be a good place for some for some shares that vest when further down the line.
Yeah, and that, by the way, is a great point, which is you could say that you've got 50% of the shares, but they vest such that 5% are vested now and then more vest once you join full time and so on. So the person has all their shares with voting rights, but if they fail to join full time, then they get taken away later. So there are many ways that you can play that. All right, and I'll do the last question from Dylan. So if you have your own startup lawyers, your own documents, can use SeedLegals? And the answer is SeedLegals has got many pieces to it. There's a cap table. So instead of using Excel, no matter whose documents you've got, you can use our cap table. You can use SeedLegals for your employment agreements, your NDAs, and whether you can do it for your funding round, well, remains to be seen. But if you drop me a note, you can certainly use it for your next round and for your option scheme. So if you're satisfied with your lawyers for some things, great, but you know, take a look, there's quite a wide range. And my goal is to provide all the pieces you need to run your business. And if you're satisfied existing in some, fantastic. Otherwise, you know, there's a new way of doing things. All right, and I'll answer the others in the chat. Thank you.
Thank you very much indeed. I appreciate your time, and I hope everybody else does. Right, Dan, do you want to say, I'm coming back more and more on this theme today of like wearing an investor's hat as a founder. Everybody has got a great idea. They need everything in place, and they need to look at it as an investor's point of view, I think. Do you want to maybe comment on that a little bit?
You're talking to me, I'm taking it.
Yeah, sorry, yes. Dan. The other Dan's not here. Kate was running. You came in just after I introduced her, but.
And I guess that's one of the things we do at Ideas Crucible is we look through the investor's eyes in terms of what they're looking at and their perception as well, because often it's nothing wrong with it as a startup. Considering at the end of the day, the focus is on generating sales, usually at the end of the day, making an attractive proposition that is sellable. But and that is probably one of the number one things, by the way, as an investor you're looking at is traction. And is this an interesting, is people interested in this? Have they validated the customer need and have they managed to sell it? But at the end of the day, there's also some other questions that they'll be looking to tick off at the end of the, to make sure whether that's suitable as well. So thanks, Anthony. I'm a big fan, by the way, of SeedLegals. Ideas Crucible are a partner. Only yesterday did I pass over an opportunity, a client over to Anthony. So, and I've got another one coming down the line as well today, actually. So, and hopefully they'll be able to pass something our way as well. So there's a question there, by the way,
just to chime in, I am a user of SeedLegals platform actually, and it's really, really great, just as a customer's perspective to throw it in.
Thank you very much, Hassan. Yeah. That's very kind.
There's a question there, by the way, on someone who's got their MVP and they wanted to, and they've mentioned they've got a total addressable market and the size of market is big. By the way, make sure it is big. I see so many startups who think if just because they've got a fintech payments proposition, they've got the whole fintech market. You know, really look to see what your market size is. And it's can the organization get investment through SeedLegals? So, well, Anthony might want to answer that. SeedLegals aren't themselves securing investment for you. If anything, they have a duty due to the FCA not to be able to do. They're not matchmaking you with investors. They can point you possibly to the direction of the right investors to speak. But I think that's right, Anthony.
That's right. We're sort of the back office that takes care of all the legals. So you find the investors. We might change that one day. We're about to launch SeedLegals Pitch next week, where you can upload your pitch deck and a video and a pitch on a page. You still find the investors yourself. So Alice, you still need to persuade investors to want to invest. What we do is we take the friction out of all the contracts to do that. So you know, your question is, if you've got some revenue, broadly, you know, I explained the different funding rounds. And essentially what it's saying is that investors are making a gamble, a bet on your business. And initially, when there's no proof point, there's just a PowerPoint, an enthusiastic founder, they're going to make a small bet. And they're often going to want their tax breaks with SEIS or EIS. But once you've got revenue, then it's going to be Series A VCs taking much bigger bets because they've got proof points. And your goal with the startup is to essentially show validation that you can build a team, you can build a product, you can get users, you can get revenue, you can grow, and investors will be making bigger and bigger bets on your business at each stage.
Can I just interrupt 1 second, Anthony? I'll drop you a line on that SeedLegals pitch concept, because there's obviously a natural synergy there, and that's a private conversation, but we'll link into that if we can.
Sure.
Okay.
Thanks.
See if there's anything else in there. Okay. Okay. Yeah. So I'm interested to know whether there's not an insignificant number of individuals here. Has anyone here actually done a first round? It'd be quite good to know. Maybe done the pre-seed round or an early round as well, because it helps maybe position what Neal and I and Anthony say. Maybe put it in the chat, or you're more than welcome to come on the video.
Yeah, please do. I mean,
so someone's done a pre-seed of £30,000 here, which, so a small round for the first round, as Anthony pointed in. If you can put some money of your own in, at least £20,000, you're going to get a lot more traction from investors who are going to be interested. It's not really because they care that there's £20,000 necessarily interested in the business. It's more the fact that if you're willing to put some money into the business yourself, take the risk, it shows that you've got an appetite and the right kind of culture to be able to follow up that business. And you've got a motivation to make it work as well, as opposed to this is something you're just playing around in the garden shed developing a bit of code or a bit of a device or widget at the end of the day. But beyond that, there are several other plays where you might want to be looking at for investment. And actually, some startups think that the goal of running a startup is to go and get investment. And as much as that helps the likes of myself and helps Anthony, just remember the goal is to generate profitable revenue generating customers. That's what it typically is about, unless you're some sort of social enterprise, but you're still looking for people to be involved. So don't lose sight of the fact that you're looking for customers. And actually, sometimes customers are the best people to be able to invest in your business. If you've got large businesses who are your clients, let's say your B2B, they may well actually be interested in investing you in as an opportunity because they want to make sure you've got a successful partnership. So cash flow neutral customers is another way to be able to look, and suppliers are surprisingly often willing to invest in your business as it's a win-win situation. But typically one of the number one ways that it's investment is after you put your own money, and that's friends and family. Friends and this you still may want to put a cap table down on, or an advisor agreement or what it may be, but friends and families, they want you to succeed. They're also one of the most forgiving if things don't work out. And having them early on is useful. They're not unlike angel investors or VCs. They're not the same level of distraction that you're going to get, because as soon as you bring investors, you've got issues of distraction, dilution, discipline. You've got to have share board meetings, delusion even necessary, the 4 Ds. So you want to be looking. So friends and families are good as well, because it also allows you to go into investors with a larger pool. Someone says, Alice has managed to get pre-seed of £35,000, congratulations. And I can see also Jack has as well. And that's sort of a good way to go into your first seed round of an SEIS, try and secure your first 100, 150K at the end of the day. Other places you might want to get well, not necessarily investment, but to bolster it is startup loans, innovation loans, grants, and that's something that you can speak to me about, and we can support you in the right direction. But as Anthony said, the first place you're typically going to get is angels. And angels are actually quite good investors. They often give far more time than they can often afford. And this is one of the reasons why VCs often put angel investors in to bolster the round, because it allows them to take a step back and focus on the big new revenue opportunity. And then you can put some experts in who are experts in the domain area, payments, fintech, medical, whatever it may be. Someone who's good on the sales side, someone who's got those partnerships, someone who can really help you drive and just provide some steer and direction, particularly if you're what I call a solopreneur, when there's only one of you. Always better if you've got at least two of them, as Anthony says, makes a massive difference. Finding co-founders is always extremely hard. So when it comes, particularly in the early stages with a startup, make sure you've got the right person. Better to get them right than mess around. Try and have to get someone out, because getting someone out is a real pain, whether it be an angel investor, a co-founder. So focus on making sure that there's the right person, both in terms of the right head and the right heart. Angel investors come in at various different ways. One is just an individual who is an angel investor, but another might be through an angel group where the opportunity has been presented to a group of individual angels. And then there's angel syndicates, where people will sit together and there might be someone who's technical, someone who's very sales, and they all put their money in, and you've got to win over a group of angels before to be able to succeed. Less so relevant these days, in my view. Angel groups are quite good. Angel networks are quite good. Angel syndicates, where everyone's chipping in and everyone's agreeing. I think there's less and less of those, particularly in the world of subscription, kind of, as opposed to you have to close one round all at once. So, and then then there's seed funding, and then there's VC funding, and now increasingly more VCs are now working at the pre-seed stage or got a separate fund to be able to keep the market, keep an eye on you at the end of the day. So further down the line, you've got growth stage VCs, and before you head into the world where Neal occupies, in the world of, for instance, sort of private equity. One thing that's often dismissed is corporate investors. Corporate investors work across the whole chain: pre-seed, seed, Series A, right down all the way to big Series C and D. And that's quite unique in the whole market, unlike your growth VCs and private equity, who are looking at some kind of second round, the accelerator kind of programs that might take some equity and give you some cash at the proof of concept seed stage, or the business angels and networks kind of operating from proof of concept typically to the first round stage. The other mechanism worth mentioning is the likes of crowdfunding, which is, and crowdfunding now tends to be working at the larger kind of rounds. It used to be where people were doing up to £50,000, whatever. Typically, the big crowdfunding platforms that you know, like Kickstarter, Crowdcube, all of which Ideas Crucible partner with and can help you with, they're typically not interested unless your minimum round is now, well, Crowdcube have now made the minimum round £150,000, just to put it in perspective. They used to have a round, I forget if it was, I think it was £50,000. Their terms now are 150. They work because they discovered that was more profitable, and they were spending a lot of time chipping away at £20,000 hit. Individual donations from individual funders may well still be quite small: £10,000 here, £5,000 here, £15,000. So yeah. I'm conscious I'm talking a lot. Is there any questions in the chat that we can talk about?
Just before you go on there, Dan, I've got an interesting statement to make, and I think it's applicable to a lot of people here. We had a company back in the days when we could hold events, I suppose 2000 to 2019, who raised some money through our actual pitch events in the City of London. And obviously things shut down, and I won't tell you who they are because it doesn't matter, but they appeared on Dragon's Den, and I think 3 dragons invested in them to give them the balance of what they were looking for in sort of pre-seed capital. They've come back to me now saying, Neal, we're raising an accelerator round, and I'm personally thinking that's great to come back to us to help. But of course, the question, I suppose, is why don't they get back to the dragons? And I think the answer is, if you're looking at, early pre-seed investors who might come into your company, they're going to come in, they're probably going to lock in some sort of deal, nurture you, help you, but then open it up to other people. What's your opinion on that one, Dan? Should the dragons be funding the accelerator, or should they be going out to a bigger audience?
So I always when Ideas Crucible doing the strategy for investor strategy, which sometimes it's surprising how many startups don't have investor strategy. I always suggest you look for angel investors who might be interested in doing a follow-up round as well as that round, because you can spend a lot of time kissing a lot of frogs, and if every time you got to kiss a brand new frog, first of all you end up with more individual personalities, organizations on your board meetings, and the fewer you get, the more easier it is to manage, and it just makes it a lot quicker and swifter if someone else is doubling up their investment the following round. And there's no reason why you can't actually work with an individual angel and make it such that they have an agreement that they will invest in the next round as well.
No, I agree with you. I suppose it depends on size and what they're looking for. If they're raising 150 and then K, and then they're suddenly raising 10 million, it might be a different scenario.
Yeah.
I'd just like to cover, for, obviously everybody's here. What we do, the Exponential Club is being set up with myself, Dan, Anthony, to do events, but also to put people in touch with people, whether it be a founder with a founder, a female founder with female founders, to discuss. We hold events, we hold capital raising events. We have our new dedicated website, which is www.theexponential.club. It's free to join as an individual member, so you'll get invited to events with discounts. It's also, we have paying structures, but we've recently just launched a basic startup members club, which will give you a listing on the site. It won't give you too much more. Paying startup members will get free pitching events, free networking events, and literally personalized invitations. So we're here to help people. My background, as Dan said earlier, is private equity. That's what we put together in the past, and it's going to take a while to get back to it with the physical networking pitching events in the city. We put 100 people in a room, 10 companies pitching, looking to raise money. We're now doing that virtual. We've got a virtual networking event for the club members. So as I say, please just join for free, attend. We've got about 30 tickets left. They're all free for the 12th of this month at 12 o'clock, literally half a minute. I'm so-and-so, this is what I'm doing. We can chat. You'll meet people from around the world. It's just great fun. It's not a pitch event as such, but it's designed to meet somebody, get on, contact them via the club and such like. And when you're raising capital, you've got to get out your story to as many people as possible. You don't just have to attend our events. I'd encourage you. There's plenty of people out there doing events in London or virtual events and such like. But the whole idea of this workshop and going forward is you can have the best jockey in the world on the best horse in the world, but you haven't got a saddle, you ain't going anywhere. Right? Get everything in place. And I know it's like a cliche, get all your ducks in line. If you're going out to investors, you must be in a position to go, okay, fine, I can take your money, whether that's through, as Anthony mentioned earlier, a seed fast agreement, pre capital raise. You have to be in a situation where somebody goes, yeah, I'll invest in you. And you go, oh, okay. And he says, send me a subscription agreement. You go, well, I haven't got one of those at the moment. Yeah. And they go, oh, well, let's not worry too much about that. Yeah. Put yourself, as I say, in the shoes or the hat of the investor and work out what they're looking for. Dan,
we've got quite a few questions here, I see.
Yeah, sure. I don't know. Do you want to answer some of them? I can't see him at the moment.
Yeah, so Jack mentions there's quite a few people, it would seem, from this event have been watching Dragon's Den.
Okay.
I agree. It's referenced a lot. My personal take is actually Dragon's Den is quite different from the real world of Angels. Remember, Dragon's Den is all about drama.
It's a TV show, but yes.
Yeah, it's a TV show. And the focus is very much on generating a bit of drama and life. I'm not suggesting those individuals don't get invested. And I actually know one of the dragons, former dragons as well, who's a friend of mine who works within the startup community, tends to work at the more larger scale. So happy to make an introduction if necessary, but it really isn't the same as typically the standard angel community. You're not going to finding someone like Theopathetus and having him turn up, who you can ring up for a piece of advice now and again when he's not running Staples is not, it's not going to be straightforward, is it? Ryman rather, not Staples. So yeah, what else do we have here? If there's any more questions, just fire away. I will put my LinkedIn and email details in as well. So I'm conscious we've got the best part of 24 people on the call. So please, either come on or speak something about it. Someone commented that friends and families aren't straightforward, aren't always there for you. They're not. And actually, there's quite a lot of investment from friends and family. They're not always immediate friends and family, or they could be work colleagues. And then sometimes they'll call them friends, families, and the fools, because there's individuals you'll know who are willing to chip in. Make sure you want that person on the board, even if they're friendly enough and they're harmless enough. Money's money at the end of the day. We've got a new message. So someone else, what's your view on bringing a business advisor at pre-stage?
I'll let you answer that one.
So I've been that. If they're bringing, right, it's better to bring an advisor on board than to make the risk, take the decision of putting them on as a director or a non-executive director, where they've got more responsibility. So, but if you are going to bring them as an advisor, taking an advisor agreement is certainly worth it, because at least it will make a lot more straightforward as if there's something a little bit awkward. There is a place for bringing an advisor on at the early stage. Think about what profile you want your group of advisors to look like. Do you want them to be technical? Do you want them to be sales? Or do you want this guy you met down the pub who seems to know what he's doing? I work as a professional advisor to some startups. If they want to know a kind of thing that someone like me does, I will refer them out to some of my other startups that are now quadruple the valuation that they are. So I let them speak, the startups that I work with and have worked with speak for me. And that's the kind of advisor you want, someone whose track record speaks for itself, either in the world of the startup ecosystem or in the large corporate world. Startup land is very different to corporate land. There's a different set of skills needed. You're taking a business very quickly and changing it. The profile and the organizational chart will be very different. Think what that's going to look like now and what it's going to look like in 6 months' time and 12 months' time. And do think to yourself, is that person that I'm pulling in going to be able to carry this journey, or is there going to be a massive high churn rate at the end of the day? So you've got a different set. You've got a journey and a transformation, and you need people who can ride that wave. And sometimes, if they just think they're coming in for a 9 till 5, it's a hard work. It's a hard life. There's no 9 till 5 typically in startup land.
Sorry, Dan, also just to interrupt there as well. Excuse me. The capital raising process is a job in itself. Yeah, it's something that, whilst you're trying to run a company, you're trying to raise money, or you're trying to set up a company, you're trying to raise money. There's no secret sauce. It's hard work, perseverance. Again, get out, meet as many people as you can, and pop your story out to as many people. My advice for early stage startups who are looking to raise would be, again, contact so much your friends and family, but you might think you've got the best thing since sliced bread, excuse the pun again, but put it out to people. Say, what do you think of this idea? And they'll come back and go, oh yeah, I quite like that. Okay. Hit your LinkedIn, hit your social media, hit your friends and family social media, expand the network on what you're trying to do. and work out if you've actually got a product or a service that's actually going to work. Because something like 60% of startups fail because the actual product or service they're offering has no market need. So you could spend 6 months, a year, input capital, do everything else, and nobody wants it. And I think that's important, Dan. Do you agree?
Totally. Yeah, totally. It's actually probably one of the number one things investors will be looking at. So the more you can validate that you've got a customer demand, and not just that, and you can prove it as well, the more attractive you will be. Obviously, the best demand is if you've got early sales, but if you've run trials, if you've got surveys, if you've got real feedback, if you can bring that feedback that you've had from reaching out to individuals, and it's different saying, do you think this is interesting? Is to make sure is one thing. Will you pay for it is often very different.
That's exactly right. You can come up with an idea. I can put it on a piece of paper now, say this is the best idea ever, right? But nobody's ever going to hear about it because you don't put it out there. They might come back and go, no, it's not. Or they might come back and go, absolutely. Why on earth didn't I think about that? Yeah. And you need that feedback, because otherwise, and I'm not trying to put anybody here off becoming an entrepreneur and raising capital and such like, but it is a very, very difficult game.
A few things worth saying, by the way, is even if you speak to a lot of investors, you tend to find that most of them are interested in you. Are you interested in us? Oh, yes, I am. Oh, how can we help? Send us some more information. What do you want? Well, we'd like your due diligence document on this, your DD document on that. Can you give us access to your data folder? And every time you speak to them, they want more information, and they're either pumping you for information because they've got a competitor, but they might well like you. But the question is, a surprising number of investors in the ecosystem don't have any money, or they've used their funding up for this particular year or quarter, or you're a bad fit for their kind of the limited partner that's funding them, or general partner at the end of the day. So don't be afraid to question them as hard as they question you. Be diplomatic, be kind. But the most important thing I would say is select the investors that are most likely to be are going to be interested in you. Don't have another competing thing in their portfolio. Look at their portfolios. Invest in this kind of area, and they also look as if they've got some real money, because it'll minimize the chances, or maximize the chances that they'll say yes, and if they do ask for more information, they're probably relevant at the end of the day. Any questions? Because Neal and I can talk forever.
Yeah, sorry, just one quick question. I think it was from Hemant.
It's a good question.
About a list of checklists of VCs and such like. What we're doing at the moment is we are building our network on the Exponential Club from investors, VC companies, SEIS, early stage companies and such like. Now, at the moment, many of them are hidden, but what they're looking at is potential deal flow and such like. They will have different requirements. Some will invest in, as we mentioned earlier, with Forresters, only companies that have got some form of IP protection, trademark and such like. But we are building our own, what I would describe as a limited LinkedIn environment, whereby there's investors and then there's startups in there. There's people just looking at networking. There's people looking at luxury lifestyle events and such like. So a club for everybody. But to answer your question, we are building that, and with our newly formatted pitch side of things, we're going to take companies literally not physical but virtual to pitch in front of SEIS, EIS funds and such like, and angels online, limited. So there might be 5 people in the room and you're pitching, or in the virtual room. Because the other thing is, people like to see loads of people in a room, but it doesn't work. You want to be speaking to the people who can actually and will actually invest in you. Yeah. And that's what we're changing now, from having obviously been a virtual for the last couple of years. And what that leads on to is actual then physical meetings to be able to go and say, okay, Dan's raising money for XYZ company. We've got so-and-so SES company watching him. They go, right, I like Dan's idea. Can you put me in touch? Yep, there you go. Go and have lunch or coffee with Dan. And off you go. So that's, like I say, coming back to how to raise capital, push out your little tentacles everywhere you possibly can to try and meet people who might go, yeah, I like you. Yeah. There is no one answer to raising capital. Sorry, Dan, carry on.
No, there's a really good question. And what's a subscription agreement from Paul here at the end of the day? Traditionally, so this comes back to what Anthony was saying. Traditionally, you used to kind of build the round up, go round, I'm giving £50,000, I'm giving £100,000, I'm going to give £75,000. And it didn't close off till you kind of had got the full number of individuals that had put their hand up. With a subscription agreement, which is a bit like, for those who are familiar with it, a convertible loan note, you effectively go to the investor and often give them a discount, 10%, 15%. If they then kind of are willing to basically say they're prepay for the shares that will be allocated to a later stage. SeedLegals have their own individual advanced subscription format known as SeedFast, and you might want to, which they use as part of the legal structure vehicle for them. And you can find out more about SeedFast on the SeedLegals website. In Ideas Crucible, when we're doing your investor strategy, we'll discuss whether it's kind of equity funding best, debt funding, a mixture, whether it be subscription agreement, whether it be convertible loan note. All these will come down to the kind of company you are, and also the kind of a stage you're investing, how much you're asking, and also how attractive you are. For those interested.
Sorry, yeah, just come back to Hemant on the VC side of things as well. I'm not a great advocate. I'm sorry, turn my video back on. Of VCs, and especially for startups, because you're probably well out of their league. I'm not saying you aren't, but most are. They'll go into VC and go, "Oh, get this VC behind us." VCs won't normally come in, and maybe it's changing to a certain extent, as Dan mentioned earlier. But you know, for 500 to $1 million, they're looking at normally exiting at 30 times return. They realise that they're not going to get everyone at that, but it's a very time-consuming deal for a startup, especially a startup, to get involved in. Latter stage, yes, no problems at all. The more money you want, the better it is, and the more chance you've got getting it. But the majority of startups are looking at raising, I don't know, 150 under SCIS, perhaps a little bit more. And as Anthony said earlier, the fund up, or the funding round stages have changed to what Dan just mentioned about the SeedFast or convertible notes, where you come in, you're going to get a discount on when you do actually raise 10, 15, maybe even 20%. Too many startups look at, what's the easiest way to raise money? VC is not the answer, I'm afraid. Dan, do you agree with that?
No, people go to VCs far too early. Just whilst you've got the audience, Neal, is it worth mentioning that you're running a face-to-face event on Friday?
Yes, we. Anybody who's here, please join the club. Again, I do want to promote it because it's, as I say, basic membership is free. The Exponential .club. We have a networking brunch in the City of London on Friday, starting at 12:30. For basic members who join, which is free, it's £46. Brunch, free flow of drinks. We've got about 20 people coming, including, funny enough, some VC firms, some private equity companies and such like. So just very relaxed. So if you're in London on Friday, again, please just look at our site, and it's very simple. It says events and it says networking brunch in London. So we'd love to see you.
There were deals closed on the last one, Neal.
Sorry, say?
There were some deals closed directly at the last one.
Oh, there was, yeah. I mean, we've got a few. you know, I don't like to mention, say like the Dragon's Den one earlier, but, and I won't mention names, but we do introduce people to potential investors, and off they go. Yeah.
We've got any questions from anyone else? Oh, Harry's asked Neil if the recording will be sent out.
Yes, it will. What we'll do is we'll send an email to everybody to our YouTube channel, so you can flick through it to obviously us, the more interesting ones. No, yeah, that'll go out probably in the morning now.
Is Adam still on the line? Because he's got a very good question. Oh, he's there. Adam, you wanted to know if finance companies are applicable for SEIS and EIS. Adam's going to speak for himself. Hi, Adam.
Oh, hi. Sorry, I thought you were going to ask me a question. Yeah, I was just.
So, what is your question about finance?
Well, I was just
SEIS?
looking at the SEIS, and one of the things is financial services, for example, and there's a list of other sectors that aren't eligible for it. How do angels in that kind of space view that fact that they aren't SEIS eligible?
It depends what kind of financial services you're talking about, Adam, because fintech is still probably the biggest area for seed investment, angel investment generally. It is the biggest area. After
can I just interrupt?
By medical and health. Sorry.
Yeah, can I interrupt there as well, Adam? I know where you're coming from, but there's many ways. As I say, use it again, skin a cat. Not that I advocate them, but you look at your business slightly differently, maybe a sort of a tech side on it or something else, and you push it out that way.
Okay, makes sense. Yeah.
Yeah.
Are you a platform company, Adam, or are you actually providing the service direct to the individual, as you're a trader, for instance?
So it'd be a mixture of both. It's a fintech, but providing, well, utilizing maybe third-party payment solutions within it. But it would be, I suppose, it's kind of on a borderline one. So I guess the answer there is it needs
probably
to be
worth a chat about that, Adam, because we, for instance, we're in the middle of advising a payments company, a European payments company at the moment, and they are applicable for SEIS.
Yeah, I think, yeah, Dan and Adam, sorry. It's important to understand it, unless you're right straight out there as a property development company or a, I don't know, something I'm involved in at the moment is yachts. Okay, for example, I can't do a charter business for yachts under SEIS, but I can do a tech side of it that would put the booking side in place.
Okay, yeah, that makes sense.
Does that make sense? So you don't shift your focus, you just shift where you're raising in that sense. Obviously, there are certain ones that are still a no-no, and Anthony mentioned a couple of them earlier. But, you know, unless you're a gas company or something like that, there's normally an angle that you can shift the investment side to then develop the further business.
Or you can split the company up into the services arm and the platform arm.
Yeah. Yeah.
Raise
on one and loan it to the other.
Yeah. I'm just in the middle of doing that for a company based out in Teesside.
Okay.
So, yeah.
Cool.
Anybody else want to chip in before we go? Oh, hang on a minute. Somebody's coming in late. We'll let them in. Hi, you, whoever just came in, or we're looking at chat. I think it's Adam, not another Adam. You know, we're here to help. So, you know, Dan from Ideas will accelerate business. We will put you in touch with, through our events, potential investors, both virtually and physically, and also via the club with personal introductions, because as I say, my background's private equity, offshore financial services since 1991. I started in Hong Kong, ended up Singapore, Dubai. I know lots of people in the Middle East, lots of people in Asia, lots of people in London who are looking to invest. So use us. Yeah.
Alice has got a good question about any particular. Oh, Alice, do you want to ask the question? I can see your microphone's on. Maybe she's Alice. Maybe not. So Alice wants to know if there's any particular sectors which were more favourable for investment. So I think, as I've just said, fintech still gets the vast majority of investment within the United Kingdom at this stage. But rapidly over the past 3 to 4 years, the medtech and health space is booming, and biotech as well is increasing, particularly when in the grasp the nettle with COVID and everything else. The amount of interest in that area is growing. So other areas is clean tech. It's still actually quite small, but the growth factor is quite significant as well. E-commerce and SaaS. Surprisingly, retail is never as big as I expected to, even online retail, but it's still there and considered interesting. Hope that answers your question, Alice. If not, stick it in the chat.
Yeah, legal tech's becoming big as well.
Got a nice graph I can share with you, Alice, if you want to know about the sectors that are interested. Any? Would it be possible to share the slides?
Yeah,
we can share a recording.
We've got the recording of the whole event, so you can go through that.
Conscious we're already at 1:30, Neal, and people.
Yeah, I know. We've got to go. Look, folks, thanks very much. Again, Anthony's gone, but please get in contact with SeedLegals for any capital raising concepts you need. As I say, you've got to have your ducks in order.
If you come through us, Neal, I'll be able to give a discount as well.
Yeah, okay, great. So please contact Dan. Yeah.
And I'll put an email. info@ideascrucible.com will land somewhere either in mine or an admin's desk.
Yeah.
What
we'll also do is we'll send an email out to everybody, probably in the morning, just with the link to the recording and also the link to Dan, myself, Anthony, and Forresters, so everybody gets contact details. I say, please register for the club. It's free to start with. We're not going to charge you unless you carry on. You're going to get discounts to come to our virtual events and also our physical events. And again, I'll just reiterate that. That's the Exponential, EXPONTIAL.club. And join us as literally part of the family. We're here to help. My network offshore is probably something in the region of 15,000 people, including the UK. I think the SeedLegals has 25,000 startup companies plus investors, and obviously Dan from Ideas has the contacts to Dragons, other people and such like, just to be able to help you. And that's what it's all about when you're capital raising. It's who you know, who you get involved with, who you know, who knows who, to raise capital. So thanks very much, everybody. Thank you, Dan. I'll see you Friday. Let's have a drink.
See you Friday. And any help, I can put one of my team onto it, and smaller we are, and help.
Perfect.
Innovate away. Lots of success, guys and girls. Bye.
Thanks, everybody. Stay in touch.